Welcome to the July and August market diary of 2023. Now let's go ahead and jump right in. The first section, we're going to be looking at different charts, see what I've been doing, and I'm going to give a short analysis of where I think earnings fell and what's going to happen going forward. So first of all, the NASDAQ rebalanced in July, and I got scared and broke all of my rules. So I sold my two best performing positions. The first one is Microsoft Corporation. And now I sold this right before earnings, and Microsoft luckily had mediocre earnings, and their growth slowed, with minimal revenue generated from AI, suggesting that the AI play is more of a long-term play in a short-term minded market. Now I sold 20 shares at $350 per share. Now the second one happened to be Amazon. Now I sold on the same day. Amazon's earnings were driven by an 11% average beat in all of its sectors, such as retail and AWS, flying past both expectations of the street and forecasts by the company. This caused a 10% stock jump. Now, I sold 54 shares at $129 per, and as you can see, the stock rocketed off of earnings. Now, both Microsoft and Amazon are dealing with FTC and EU probes and lawsuits at the moment. However, Microsoft at least seems like it is about ready to be jumped back into. Amazon, I might wait for the 132, but we'll see. Either way, I don't have the money for it right now, so it's kind of a moot point. Anyways, moving on. What did I do with the money that I sold from Microsoft and Amazon? Well, I bought a bunch of broad market ETFs. Unfortunately, the S&P had a very mediocre to bad end of the summer. So now Vanguard's S&P 500 ETF VOO. Now I bought both at the beginning of July and towards the end of July, right after I sold Microsoft, and at an average fill of 415, you can see I'm just barely breaking even with this. Now VOO Growth, I bought one time. I bought 28 shares at just under 260, and as you can see, I am just barely making. I'm just barely making a profit here. Now, the S&P has had a sluggish 2 months, and we're expected a rebound going into the holiday season to close out the year. The problem is it's very hard to unwind these two trades and get back into tech when they're trading close to a loss to where I purchased it at. Now, this is a very good long-term hold, but it's kind of annoying if I'm trying to get back into Amazon and Microsoft because now I have about $14,000 tied up in these two stocks. So I didn't just do large cap, I also did small cap, but small cap didn't do much better either. Now, Vanguard's small cap ETF VB is kind of looking like a year-to-date sine wave. Looking back over the last 20 years, there's definitely more room to grow, and it is off of its 3-year high, but short term, I'm predicting it's going to remain sluggish. As you can tell, I bought 8 shares at about $206, and I'm way below that purchase price right now. Same thing with the growth version of the small cap, and that is also way under the 236 that I bought it at. Luckily, I'm only in for 8 and 7 shares respectively. So now, pardon my pun, but we did pass some gas. Exxon Mobil Corp is doing fairly well right now. So at my average purchase price of $105, I am doing quite well with it, and Exxon, even though they had a very, very sluggish earnings call, which you can tell from this dip right here, where they did not meet expectations, Exxon is still very profitable, even though it's not reaching the same heights of their record-breaking 2022 year. And like I said, they failed to meet earnings expectations, but throughout August, the stock price did go up directly because crude oil went up. So I am expecting, as crude continues to work, Exxon will continue to be around that 115 price point. Now, Enbridge, on the other hand, I have an average purchase price of about $37.5. It is very much below that, and that is due to, well, two things. First of all, oil and gas are beginning to enter the M&A stage of their business cycles, and we're expecting to see a lot more mergers and acquisitions throughout the next few years. Enbridge is getting a flying head start as they just spent $14 billion, a mix of cash and shares, to buy U.S. utilities from Dominion Energy, which is a very good long-term play, but it hurts the shares in the short term, especially from the dilution that came from that $14 billion. Um, prices are also um, prices are also like having an issue because all Toronto listed companies, and Enbridge is a Canadian company, are dealing with the interest issues coming from the Canadian Central Bank. And Enbridge is trying to diversify more into the US market, but as you can tell, shares are down. I might actually try to buy 100 more shares to kind of average down, especially seeing it is so much below my average purchase price. But we'll see. Again, that's at current rates, that's about $3,500. Don't really have that money to put into it right now, so we'll see where I want to go with Enbridge. But we do have two new outperformers. The first one is Walmart. Now, Walmart's average purchase price was $142, which is not even on this chart. It is up a lot. Now, Walmart was making several moves and had a great earnings season. It's broadening its technology play, which helps with its online store, its targeted advertising, its in-store and delivery logistics. It's also trying to lessen its shrinkage by eliminating self-checkout, which, if you know anything about Walmart, its shrinkage is about $1 billion a year that they're losing to just theft. So the cost of having a couple more cashiers versus $1 billion in theft, it's nice to know that we're going back to cashiers. I, for one, am very happy about that. But it's also the retailer of choice during periods of inflation due to its low costs in like very major metropolitan areas. And it's well positioned going into holiday season as well to capitalize on some of that gift buying spend, and also some of that, general decoration spend. Walmart's very well posed for the next couple of quarters. Now, Ares Capital Corp, this is something I didn't expect, is doing very, very well right now. I did actually buy a couple more shares at an average to make my average purchase price now $18.02, which isn't even on this chart. So Ares is doing very well. Plus, it is still doing a 10% dividend. So now, ARC is buying debt and it's positioning itself to be well protected from widespread defaults. It is a mid-small cap loan issuer, and it's one of the few BDCs that are in a solid financial position right now. Its dividend and assets are solid for a mid to high risk stock. Now, a lot of BDCs have a bad name because they are not financially well positioned and they are considered very risky stocks, especially their dividends are not considered solid. Ares has a very long history of maintaining its dividend, and it also has a very good debt position. So I'm not worried about it, and the fact that the stock is going up and they're maintaining their dividend is making me very happy to be in it. Now, here's my actual portfolio right now, and as you can see, I've added a couple of columns. I've added a management fee and an annual cost because ETFs have a cost to them. It's about $11 for the amount of shares I currently own. I've also added the current value versus the cost of the trade, so you can get a quick idea of whether that is up compared to what I paid for it or down compared to what I paid for it. And overall, I am up on the overall positions throughout all of them. Now, I am about half of the portfolio is negative year to date, and almost all the single stock picks I've done are positive, and 75% of the ETFs are negative. So overall, this means that I'm 2% up over the cost of the trades. This doesn't include the $4,000 of tech gains that was reinvested into the broad market ETFs that you see. It also isn't including the year-to-date market gains, which are dividends, interest, and realized gains, which total about $4,600 right now. My current unrealized gains is about $1,000 by comparison. So if we include all gains, unrealized and realized, my portfolio is up about 12% year to date over a funded cash basis of about $41,000. Now, I may consider adding another $4,000 to get some more exposure to Microsoft, Amazon, or increasing my exposure to Enbridge, but I don't really know when I want to do that or when I'm going to be liquid enough to do that. So right now, I'm going to just be happy with the fact that I'm up 2% on a total portfolio basis and 12% up for the year. Not to mention, our quarterly dividends have now hit over $400 and has hit an amortized amount of about $135 a month. This is about a monthly yield of 3.45% per month, which is quite frankly very good for dividends. It's below the market rate of a money market account, but I'm very happy with where that dividend is sitting right now. And I probably will get that higher as I invest more into ARC and into Enbridge, which are my two biggest dividend yielding things at 7 and 10% respectively. Now, let's look at the sellouts. So if we're just looking at the Excel sheet and what happened, we made about $4,000 off of Microsoft and Amazon, about $2,000 each. And then on the good guys front of things, we have both Walmart and ARC. As you can tell, Walmart's hit 3 of its 4 dividends for the year, and its total profit loss is about $715. ARC has had one of its dividend payouts and is about to have a second dividend payout at the end of September. And as you can tell, I'm up about $400, which will be about $500 once that dividend hits and if the price maintains. Now, all of these end-of-week prices are the prices as of August 31st. So this isn't the date as of today. It's as of August 31st. Now, the ETFs have arrived and have not performed well. I'm saying failed, but that's just me being hyperbolic. Now, VOO, it's down about $45, and the growth version of VOO is up about $31. So kind of a wash, but still annoying. Now, both of my small cap are down about $40. So overall, we're looking at about $100 loss here. Now, for the oil barons, and Exxon is actually up almost $800, which if you have watched the last couple of market diaries, you'll know Exxon has been kind of sluggish, and I've just been kind of like, don't worry guys, it's going to come back. Enbridge is now in the same position Exxon was, except Enbridge is dealing with a but it's dealing with a diluted share issue right now. Now, if you include the dividends, it is up. I've only lost about $250. If you strip away those dividends, I'm down about $500 off of just the pure stock price. So I need to figure out what I want to do with Enbridge, but we might try to get her up to 300 shares. We'll see what I want to do there. But this is the current breakdown. Now, how has the beginning of half 2 of 23 fared so far? Well, at the beginning of July, so the beginning of that month, we had $40,000. At the end of August, so 2 months, it's now at just shy of $47,000. That's a 2-month profit of loss of about $5,500, about $4,000 which came from tech, and the profit of loss since open of all my current shares is about $1,500. Now, was selling tech the right move? If you couldn't tell by my annoyance throughout this video, the answer is no. Why? Because even though I saved about $450 on Microsoft from their bad earnings, I lost about $490 off of Amazon from their fantastic earnings, which means my total opportunity loss on those two stocks is about $35. Now, the ETFs, we have to add to it because I rotated out of tech into broad market ETFs. Now, my profit or loss since opening of all my ETFs are just shy of $100, which means my total opportunity cost loss was $135. So all of my positioning, because I made a panicked decision, was about $135 this month, which in comparison to my whole portfolio isn't a ton, but it still, shows me that I made the wrong decision in the moment. Now, could both Amazon and Microsoft crash down to unheard of levels and we enter an awful market? Yeah, but my ETFs will go down in that case too because they disproportionately are tracking Amazon and Microsoft anyways. So, it is what it is. Will I stay in those two? Yeah, probably. But anyways, my plan for September, I'm going to reinvest the dividends. About $200 have already come in for September. We'll end September with about $300 in dividends. So I'm going to need to fund my account a little bit plus use those dividends and put them somewhere. Where I'm going to put them, I don't know yet. I'm also going to try to re-enter Microsoft or Amazon through funding my account. I don't know which one I want to re-enter. Microsoft's cheaper right now, so I kind of want to do that before it re-hits its old highs. And Amazon is currently making a decent amount of money and appears to enter the holiday season in a very good and strong position. Now, I do also want to analyze the quarterly reports. Now, I'm doing this in my own time, but I do want to try to make videos on it. I'm heading into a very busy time in my life right now, so I don't know if I will be able to make more than just these once a month videos, but I'm going to try. But at the very least, I want to analyze the quarterly reports a little bit more in depth. Now, here's my rules of engagement. Clearly, I broke one of these rules. Long-term gains only. I sold Amazon and Microsoft after only being in them for 3 months. That's not long-term gains, so I broke this rule. Now, I want to try to get back to following these rules, but we'll see. I've been good with all my other holdings, so having one moment of weakness isn't really too bad. And most of the other goals and rules I've kind of held to. Anyways, here's my end of video disclaimer. Please read it, and as always, thank you very much for watching, and I will see you at the end of September for the next update to this journey I'm taking you on with my portfolio. Thank you very much for watching, guys. I will see you all next month. Bye.